There's a moment that doesn't look important from the outside, yet quietly changes how a person relates to money. And it usually happens the first time someone invests, even a small amount. Not because the number itself is large, but because the role of money begins to shift from something that is spent to something that is positioned. And that shift is less about finance and more about perception. Because up until that point, money tends to feel like a tool for immediate needs, something that flows in and out with little sense of continuity. But the act of investing introduces a new idea, that money can exist independently of effort, even if only slightly at first. And that realization often creates a subtle psychological tension between spending and allocating that didn't exist before. In the beginning, the amount is usually modest, sometimes almost insignificant, and the outcomes are rarely dramatic, which is exactly why the shift is easy to overlook, because nothing visibly changes in lifestyle, income, or security, yet internally something recalibrates as attention moves from short-term transactions to longer-term positioning. And this is where the psychological layer becomes more interesting than the financial one, because the brain begins to track time differently, not in days or weeks, but in compounding intervals, where patience starts to feel like a variable rather than a passive state. This is also where expectations often need to be adjusted, because the early stages of investing can feel underwhelming when viewed through the lens of immediate reward. And without a clear understanding of exponential growth, the process may appear slow or even ineffective. Yet mathematically, this phase is foundational, because small base values require time before percentage growth becomes visible in absolute terms. And during this period, the primary function of investing is not to generate noticeable returns, but to establish a system that can scale, which is why consistency tends to matter more than intensity. At a deeper level, the first investment introduces a separation between income and wealth, which are often treated as interchangeable but operate very differently, because income is typically linear and tied to time or output, while wealth, even in its earliest form, begins to follow a non-linear path influenced by compounding, volatility, and time horizon. And once this distinction becomes clear, decisions around money start to reorganize, sometimes gradually, sometimes almost immediately. As spending is evaluated not only in terms of cost, but also in terms of opportunity. Opportunity cost in this context becomes more tangible, because every unit of currency now has at least two possible futures, one where it is consumed and one where it is deployed. And while this trade-off always exists, it is rarely felt until there is an active investment to compare against. And this comparison doesn't necessarily lead to reduced spending, but it often leads to more deliberate spending, where choices are weighed against future potential rather than just present satisfaction. There is also a behavioral feedback loop that begins to form. Even small fluctuations in investment value create emotional responses that were previously reserved for income changes. And this can introduce both constructive and unhelpful patterns, because while it can increase engagement and awareness, it can also lead to over-monitoring or short-term thinking if not balanced with a broader perspective, which is why understanding the underlying system becomes more important than reacting to individual outcomes. From a systemic point of view, the first investment is less about entering a market and more about entering a framework, one where capital interacts with time, risk, and probability, and where outcomes are shaped by aggregation rather than single events. And this framework operates regardless of scale, meaning the same principles apply whether the amount is small or large, which reinforces the idea that the initial step is not about magnitude, but about alignment with a process. Over time, this alignment can lead to an identity shift, where a person no longer sees themselves solely as a consumer or earner, but also as an allocator of capital. And this change tends to influence behavior in subtle ways, from how financial information is interpreted to how decisions are prioritized. And while it doesn't eliminate uncertainty or guarantee specific outcomes, it does create a different relationship with money, one that is more structured, more intentional, and more connected to time. And in the end, the significance of the first investment is not defined by its return, but by the perspective it introduces. Because once money is seen as something that can be positioned rather than simply used, it becomes part of a larger system, one where patience, consistency, and understanding gradually replace urgency, and where the most meaningful changes are often the ones that are least visible at the beginning.